Good evening. This side Rahul Magan here as a Group Chief Executive Officer, Treasury Consulting, and also a venture capitalist. As we speak, Treasury Consulting is a multinational headquartered group based out Singapore. We are a multinational hedge fund who do operates in United States, Europe, Asia, currencies and commodities. But like I repeated many times, our fund is a prop fund, which means no third party can invest capital in our fund. No third party can invest capital in our fund. Apart from that, we have many more products. In case you wish to have any information, you can WhatsApp 9899242978, or you can WhatsApp at our back office 9818485155 9818485155. Nowadays, there are three kind of wrong precedent which is being set up in the Indian capital market. Three. And I would be covering all three, but in a phased manner. So please don't expect I would be covering all three in a detailed in this video, but yes, I would be touching all three in this video. So number one, from the last 1 year, Indian investors are witnessing that loss-making companies are getting approval. We have seen Paytm, Zomato, Policy Bazaar, Nikea, Cartrade, Oyo, Delivery, and many more loss-making companies. And how much money investors lost in these loss-making companies, that is definitely a concern. But that's a separate thing that the compromised media of India will never discuss that. But yes, every passing day, investors are losing the money. The latest is the example of Paytm, when two investors, Ant Financial and Alibaba, who were having jointly 1.12 roughly billion of valuation, 1.12 billion of valuation, and they quitted at 5.3 million, which means they took the haircut of around 100%. 100% haircut they have taken. But India is definitely a great country, because even after this, no one talked about this aspect. No one. And I don't expect anyone to be talking about this. Let it be honest. So number one is the loss-making companies are getting approval. And I am very sure that this process would continue. In the sense probably for another few years, this process would continue, because we still have many loss-making companies, those who have substantial losses in the books, and they would be launching their IPO. And they can't sustain without IPO, because if there is no IPO, how would the venture capitalists like SoftBank, Sequoia, Tiger Global, and all these would get the money? Because operationally speaking, the company is loss-making. That is very important. So after IPO, go to hell, the investors they would be making the money. That's a separate thing that the SoftBank Vision Fund did reported near about 27 billion of loss. Let me repeat, 27 billion of loss in this current year 2021, but not a single business channel dared to cover this. Not a single business channel. And this is the same SoftBank, I repeat, same SoftBank who invested heavily in the Indian startups. So guys, second thing which is happening is the companies, those who are raising the money, profitable, they are using the money to repay the existing debt. Now here I am not specifically quoting any name, but from the last several months I am watching the people, those who are raising the money. And the kind of balance sheet I am witnessing, like very recently, one automobile company planning to have IPO. And they openly mentioned that they would be using the IPO proceeds to repay their existing debt or to mature their existing debt. This raises a big question, at least in financial terms, which is, can IPO money be used to repay the debt? You are a private company. You are holding a debt in your books. Now you are raising the money from the investor. And majority of the investors do not know how to study the balance sheet. They do not know how to study the analytical ratios. Rather, they do not know the difference between current asset and current liabilities. They only believe that SEBI has given the approval of the IPO, and we know the performance of the IPOs recently, including LIC. But to be very honest and precise, can a profitable company, but still holding a debt in the books, can the IPO proceed of that debt be used to repay the existing debt? I don't think so. This is fundamentally right. Because initial public offer money can only be used for working capital purpose. It cannot be used to repay the debt. But yes, if the system is allowing the use of IPO money to repay the debt, then we are setting up a wrong precedent. And this isn't the first time when India is setting a wrong precedent. History is witness that in the capital markets, we set many wrong precedents like Diwan housing, infrastructure leasing and financial services, phase out of the Yes Bank 81 bond, Lakshmi Vilas Bank, and many more. PMC Bank and many more. We have set many wrong precedents. So guys, one thing is supposed to be very, very clear and upfront is that a loss, even though you are a profitable company, but you are not supposed to use the IPO proceeds to pay your debt. Because if you are using the IPO proceeds, then it means it is a kind of loan you have taken. You have taken loan at a throwaway price, because in equities, there is no guarantee of the dividend. Example, I am a company, private company, and let's take my favorite name, Ram Lal Chole Bhature, my favorite name. So I am the owner of Ram Lal Chole Bhature, and I have 100 crores of loan in my books taken from ICICI Bank at 8%. Now this loan is increasing. Basically, the cost is increasing. How it is increasing? Because common sense, that the RBI is hiking the rate. Since the cost is increasing, what I'm doing, I'm not financially, I am not a position to take more loans. Reason, my bottom line, also known as PAT, profit after tax, is mere 10 crores. So Ramlal Chole Bhature is having 100 crores of debt and a bottom line of mere 10 crores. So I cannot take the more debt. One thing I am clear. What I would be doing, I would be taking the IPO approval. And once I am taking the IPO approval, the corrupt and the compromised media reflect on the TV that this is a profitable company. See, guys, this is a profitable company, but they have a debt in the book, which, by the way, is much more than your bottom line. We have many examples. We have Tata Motors, we have Tata Steel, we have Adani Group, we have many more companies where the debt levels are exorbitantly high, which generates a concept called finance cost. That's a separate thing that we do not know what the hell is finance cost, and we also do not know how to handle this finance cost. Now, to be honest, if these companies are allowed to take the IPO, then the Ramlal Chole Bhature would be raising 40 crores from IPO. And I am going to be using this 40 crores. Out of 40, 30 crores I am using to repay the debt. So I was having 100 crores of debt, 30 crores I paid. And from where did the 30 crores came? It came from the common sense, from the equity. Now, since it came from equity, I'm not obliged to pay any dividend. Because regulatory wise, there is no obligation to pay the dividend. If you pay the dividend, that is your mercy towards the investors. This raises a severe and blunt question. How can a company whose debt is many times, I repeat, many times of the bottom line, which is called PAT, how can this company be approved for IPO? This fundamentally is not correct. So 2 points I raised. Number one is the approval to the loss-making companies. And recently, what had happened to Paytm is a live example. Secondly, the approval of a profitable company, but still their debt is many times than their bottom line. This is completely unethical. Third, the liability of the investment bankers. This I would be exploring more in a separate video. But in short, 99% of the investors are not financially capable. Now, by financially capable, I mean they do not know the cash flow statement, they do not know the profit and loss, they do not know the balance sheet, they do not know the ratios, they are not very competent, technically competent people. They rely on the investment bankers. Since they rely on the investment bankers, they should have some liability. If IPO flops, then investment banker is responsible because they are the gatekeepers. And recently, Securities and Exchange Commission, United States SEC, at least did a good step whereby they made these, iBanks, investment banks, accountable for the listing in SPAC, Special Purpose Acquisition Company. But I'm sure that this would never happen in India. Of course, this third point I have just raised, probably in another video I would be exploring more. This is Rahul Magan from Treasury Consulting Group. You knew my personal number, 9899242978. 9899242978. Have a great time ahead. Thank you.